I hope everyone is having a nice spring. We are back with another market commentary video, sharing slides on the most interesting and important themes in markets today. So April was an ugly month. May has turned out to be pretty good. The old narrative of sell in May and go away is starting to leak some oil when you look back at the past, call it 7 to 8 Mays have been pretty good. So nothing is black and white in investing, and there's no absolute rules. In this series, we are going to cover the monthly market action for asset classes that matter to our clients, some data on inflation. It's actually anecdotal data on inflation, AI, gold, and market sentiment. So let's get into the slides. Today is May 28th. Per my comments at the open, May has been a pretty good month. You see a bunch of these equity and bond asset classes down here all clustered together, and there's one outlier. The outlier is the Bitcoin ETF. So again, Bitcoin is a polarizing asset class. I know some people like it, some people hate it. We own a small position in Bitcoin for a good chunk of our clients, and you can see it's nice when it moves in your favor. Bitcoin up about 20% in the month of May. And then down here, we have the S&P 500 up about 5.5%. Foreign stocks, emerging markets, small cap, the Dow, real estate, gold, and some bonds. It's really nice to see some of these other asset classes. I talked about this last month where emerging markets was actually one of the only positive asset classes on the month. And then another quirk to this market, and this has been true over the past couple years, is there's quite a big divergence between the Dow, which the Dow is kind of a novelty index. It's only 30 stocks. It's weighted a bit funky. I'm not going to get into that. And then the S&P, which is a more broad measure, a more accurate measure of the largest 500 companies in this country. But many people always ask about the gap between the Dow, which I believe on a year-to-date basis, the Dow's up about 3%, the S&P's up about 10%. The difference in those numbers is really the big tech companies. So again, it goes back to how it's weighted, the number of stocks in the index, and the quirkiness of the Dow. And then looking at bonds are still negative on the year. They've probably been the biggest drag for multi-asset class portfolios, but things are starting to turn. And we've covered in previous videos and in previous blogs that although predicting equity returns is virtually impossible, especially over the short term, bond returns are heavily influenced on starting yield. And it looks like the Fed has paused, with the next move being a potential cut. So what that means is if the current 10-year U.S. Treasury yield is hovering around 4.2%, future bond returns going forward over the next 5 to 7 years, let's call it, should closely track that. Okay, you can't set your watch to it, but empirical evidence would suggest that future bond returns are heavily influenced by today's current yields. So if you think about total returns for a balanced portfolio over the past couple years, bonds have been a drag going forward that could turn into a tailwind. So markets are hypersensitive to the monthly inflation reports that come out. April, we got a pretty dirty inflation report, meaning inflation was higher than expectations. May was the opposite, where we got a better inflation report. And if you reconcile the market action, April bad, May good, a lot of people point to inflation. And over the past year, inflation has certainly trended in the right direction. It's come down. But as we've approached the Fed's 2% target, it's not uncommon for there to be fits and starts. In some months, you're going to get good reports. Some months, you're going to get bad reports. And inflation, a lot of the components that comprise that basket are very noisy. And then also, what's reported in real time, the Feds can go back and revise the numbers up or down depending on the latest data and the latest revisions. So it's a noisy metric. It's a noisy data set. I wanted to show this. This is more anecdotal, but I think it's a trend in the right direction where these big retailers, fast food restaurants, Walmart, are starting to discount prices. Consumers are changing their behavior. They're not willing anymore to pay up for something that they used to pay a lot less for, and that's a function of a free market economy. Consumers change their behavior based on price and their resources. So McDonald's launched a $5 value meal. Wendy's announcing a $3 breakfast meal. Walmart is rolling back prices. If many of you are old enough to remember the Walmart commercials where the prices are falling back, that's starting to happen again. Target is reducing prices. So this is anecdotally a good sign. Consumers are tapped out, they're changing their behavior, and retailers are responding by rolling prices. This might take a while to flow through to the inflation numbers and the consumer spending numbers, but again, a good sign as the Fed tries to get inflation back down to their mythical, magical 2% target. Let's switch to AI, and this is a graph that shows the value in market cap in billions of the energy sector and the net income of the energy sector compared to NVIDIA stock. So we're comparing the energy sector, which is comprised of 25-ish companies, versus the value and net income of one company, NVIDIA. So this is not you should buy NVIDIA stock or not buy it. This is just context. And I think it's important to zoom out when some of these themes, these hot investment themes people are talking about it. So I hope to provide a fresh perspective here. So what we're looking at in the left column is the market cap or the value of each company within the S&P energy sector. So there's some names you probably recognize: Exxon, Chevron, Conoco. And the bigger the number here, this is in billions. And as we go down, the numbers get smaller. So this is biggest to smallest company size. When you take in the aggregate, the value of the energy sector for the S&P, it's about 1.7 trillion. Down here, we have the value of NVIDIA, one company, 2.6 trillion. So NVIDIA is worth about $1 trillion more than the entirety of the energy sector of the S&P 500. Looking at net income, so we've tallied the net income over the past 12 months for the entire energy sector. We've added it up. It's about 128 billion. And we look at the past 12 months net income for NVIDIA, it's about 43 billion. So NVIDIA is worth about $1 trillion more. Its net income over the past 12 months is about 60-something% less. And again, I'm not trying to say that this is a sign that NVIDIA has gotten ahead of itself. This is not uncommon for a growth company to be worth more today with the expectation that they're going to grow into that based on their future opportunity set and their revenue run rate and their growth rate. What I'm saying now is some people are pointing to this and saying this is evidence that AI and NVIDIA has gotten ahead of itself. I'm not saying any of that. I just want people to look at this with a fresh perspective. So you're comparing old school energy with a hyper growth company. And again, this is not earth shattering, but I think it helps to think about things in a slightly different way. So a few months ago, I looked at various major tech releases and how the NASDAQ performed over time, both before and after such major tech releases. And a lot of folks compare the internet boom of the early and mid 90s to the AI boom. So I just wanted to loop back to this. And essentially, this is NASDAQ composite performance. So the NASDAQ is simply a basket of tech stocks post-release. So in yellow, we have America Online. You can see that journey here. Purple is Netscape. You can see that journey here. And red is post-Chat GPT launch. And you can see that journey here. Well, you can see this is tracking fairly closely, right? When you look at the red line and you fit it to the purple and yellow line, there's a clear trend to the northeast corner, right? We're about halfway through the journey. So it's been about 350 days since Chat GPT launched. Another thing I've noticed is this is not a smooth ride. There's all sorts of fits and starts here, some massive pullbacks. So some would say this would indicate that the AI theme has legs. Some might say this is evidence that it's a highly speculative and wild asset class. I think you could make the case for both, but I think this is interesting to see how markets react post some of these major tech launches. All right, so now let's get into sentiment. And this is an interesting chart that you probably won't see on Bloomberg or CNBC. So what this is, we just got through quarterly earnings for the first quarter of 2024, and our research partner Bespoke actually tracked AI mentions on quarterly conference calls. Okay, this blue line marks the launch of Chat GPT. So everything to the left is before the launch, Everything to the right is after the launch. Then you have Apple, Amazon, Meta, Microsoft, Google, and NVIDIA. So Bespoke is tracking every instance of AI mentions on these calls, pre and post Chat GPT. And you can see NVIDIA by far the leader in the clubhouse before the launch. You can see post-launch, a lot of these companies, that's all they're talking about is AI. And I think if you were privy to this information and you were astute, you might have saw the writing on the wall and had NVIDIA as an early adopter, early leader in the AI movement. No one could have predicted it would have exploded as much as it did. And again, we're still in the early innings. But again, this is what people are talking about now. You can see the mentions. So we sum up all of the mentions for all these companies. What's also interesting is it tracks the laggards too. So Apple, it's not a secret that they've been behind in the AI race. They're slowly starting to catch up, adding AI to their hardware, also potentially producing their own chips. But this is just a cool look at what these companies are focused on and some of the early leaders in the clubhouse against post-launch and what these companies are talking about now. But know that certainly NVIDIA has a massive advantage, first mover advantage in creating these AI chips that power these language models. But Google, Microsoft, Meta, all of these companies are coming. All of these companies are trying to create their own chips to supplement the NVIDIA chips and potentially maybe even take over, because it's much cheaper to build that in-house eventually if you can scale it and get it to work versus buying from an external third party. And I think the margins support that story. And NVIDIA margins are running like 60+% right now. Know that a lot of these companies are looking to chip away at that. Now let's talk about probably the opposite of AI, gold. So gold has been on a sneaky good run, not just this year, but over the past couple years. So this is a chart of gold cost per ounce in dollars over the past 12 months. And, you know, gold is another polarizing asset class. Either you love it or you hate it. And whatever your reasons for liking gold, some people say it's a hedge against inflation. Some people say it's a good hedge against the geopolitical risk out there. Some folks claim that a bureaucrat can't mess with it. You can't print more gold. It's a tangible thing. We personally, or Pure Portfolios owns gold because it acts differently than stocks and bonds. So, you know, if you're a multi-asset class investor and you have 8 or 9 asset classes, it doesn't do you any good if they all move the same. By introducing gold, it's been proven to act differently than some of those traditional asset classes like stocks and bonds, which can reduce the overall risk of the portfolio. So gold has been a pretty good place to be. I believe it's up about 14 to 15% this year, and it's also subject to our trend and momentum rules. So, you know, when gold's doing well, we might own a little more. When gold's doing poorly, we might own a little less. But again, in a difficult market like 2022, there were a few places to hide. Gold was one of those places. Continuing on the sentiment theme. So this is the CNN Fear and Greed Index. And it's basically a survey, an investor survey, getting people's feelings about the stock market. And I always say that sentiment follows price. And this is a really good example of that. So the Fear and Greed Index, when we get a difficult month like April and the start of May, people are fearful, right? So April was down. The fear index was ticking towards that direction. Markets down, fear up. Fast forward to May. This is as of the 24th. It's been a pretty good month. Now people are feeling okay to the point where they're almost greedy. So again, this is a cautionary tale that sentiment follows price, and that you probably shouldn't even listen to what people are saying, because one could make a strong case based on evidence that if you just did the opposite of what people said, you might create a nice little trading strategy for yourself. Meaning when people are screaming for the exits and selling stocks and thinks things are going to get worse, that's usually a decent time to buy stocks. Conversely, on the other end, when people are greedy and they're telling you how much money they made in AI and how investing is easy and, you know, they're trading and printing money, that's usually a time to pump the brakes and exercise some caution. So this is one of the things, one of the consumer sentiment, investor sentiment things that we watch here at Pure Portfolios. And again, it wouldn't be the worst strategy just by doing the opposite of what people think. So that's it. Short and sweet this month. It was a pretty good month coming off a dismal April. If you have any questions based on what I covered, if you want us to look at your portfolio, if you want me to cover a certain topic next month, shoot a note to insight@pureportfolios.com. Thanks for watching. We'll see you next month.